Peter, fantastic to catch up with you. It has been about
Hi,
the
John.
haves and have-nots, but we've thought about that increasingly at a sector level. You're looking at the impaired sectors and the sole survivors may be the winners within. Can you tell me a little bit more about that?
Well, I think it's important to emphasize that one of the differences between the cycle that we have entered and perhaps the one that we saw after the financial crisis is that there was very little destruction of capacity after the financial crisis a decade or so ago. Very low rates and the opening up of credit markets allowed many companies to fund themselves, and that precipitated the long underperformance of value and cyclical parts of the market. Of course, alongside that, falling bond yields and relatively low growth also helped the growth components of the market to outperform. I do think one of the things that's changing, in line with your report just now, is that capacity is leaving some parts of the market, and that's going to leave the remaining players in a stronger position to be able to perhaps raise their prices or their rates of return on capital. So I do think we're going to get bigger differences between relative winners and losers.
Just in terms of creative destruction, many people, Peter, have pushed back against that and said the Federal Reserve has impaired the transformational forces of capitalism that you might expect in a big downturn. Are you pushing back against that view a little bit here?
Well, in some respects, of course, it's true. I mean, the Federal Reserve and other central banks are pre-committing to keep interest rates extremely low, and that did happen after the financial crisis a decade or more ago. I think the difference this time is that because prices have come down so far, you are getting some marginal players being squeezed out, and that will improve the relative position of some of the stronger incumbents. But I also think you have to bear in mind that, one important difference is that governments are spending a lot more money, and they plan to continue to do that. And that, again, will begin to help some of the areas of the market that have been left behind in an environment where you were seeing very low nominal GDP and also fiscal austerity. So things that are linked to increased fiscal spending, I think, will also see some increased relative benefits as we move forward.
Well, Peter, let's talk about the laggards. Where are they, and where are you more constructive where maybe other people aren't?
Well, oil is one that fits in with that. And we do think that, you're seeing a stronger position for the main oil producers, and much of that is in Europe, and I think it links very much with an important emerging growth area in clean energy and indeed clean technology. Europe is leading the way. We've already seen quite a transformation of the utility sector, which was a very laggard sector through much of the last 10 years, but has sort of reinvented itself as it has greater exposure to renewables. And I think the oil majors themselves will increasingly step up their transition to lower carbon outputs, which again will mean the stronger, bigger companies will be in a better position to do that and generate higher returns.
Peter, what's always interesting when I catch up with you is just how constructive you are on the composition of European indices, because a lot of people would say that's the reason for the underperformance over the last 10 years. Do you see it the other way round? Well, I think there are two big factors of the underperformance in the last 10 years. In fact, as you say, it is a bit the other way around. It's not just that Europe has underperformed, it's that the US has significantly outperformed all major markets. And a lot of that was because there was better growth in the US, but also importantly because technology was the leading sector in terms of performance, and the US has just got a lot more of it. And the US was seen as a relatively low-risk place to invest. The dollar was also rising, which kept many US investors domestically exposed. As we move forward, though, I think it is important to emphasize that you are getting an innovation in the exposures of other markets as well. They are becoming more growth-orientated. So technology, for example, in Europe is now more than 3 times bigger than the auto sector. It's bigger than the oil sector, and it's about the same size as the bank sector. And what we call the granolas, the 11 biggest companies in Europe that make up that mnemonic because of the letters that start their names, these granolas were 10% of the market a decade ago. They're now a quarter
of the market in Europe, and they are generally growth companies in the technology, healthcare, the food and the luxury sectors, and they are becoming a bigger component. So they're offering more opportunities for global investors.
At a time when we see a little bit more instability in several states across America, in fact, many states across America, Mohamed Al-Erian came on the programme last week, Peter, and he said we're not seeing a synchronised reopening process across geographies. It's very divergent, very fragile. And I just wonder whether in that world that we can see some real relative outperformance in places where the reopening process is more successful. Are you having that conversation in London right now with people looking at Europe increasingly?
We are, John. Yeah, I think there are two aspects of this. One of them, as you say, is that Europe is opening up and easing its lockdowns quicker than the US, and perhaps to some degree more successfully. And that also is likely to generate, for the first time since 2005-06, a period of 2 or 3 years where the European economies actually outgrow the US. In other words, they have a higher growth rate. And of course, the third thing that links with this is that for the first time for a very long time, at least in the Eurozone, there is a degree of increased confidence that the fiscal authorities and the ECB are working in tandem to create a more supportive growth environment, and that's reducing the relative risk premium. So I think for all of those reasons, we're certainly seeing more interest in European exposure and indeed US investors to diversify more globally, and potential weakness in the dollar over the medium term may be an added incentive in that direction.